welcome back to the review of Word on the Street presented by Warren Street Wealth Advisors. This is the show where we're going to talk all things markets, global events, and really trying to relate it back to our clients' portfolios. So I'm Philip, I'm one of the hosts, but really, I'm just a guy, even if I'm senior portfolio manager here at the firm. With me here, I have Blake Street, who's not just a guy. You're the co-founder of the firm, chief investment officer, avid pickleballer, awesome monkey bread baker. I could go on and on. But Blake, it's a pleasure to have you here. Thanks for joining me for this reboot.
Now I'm hungry. Thanks for bringing up monkey bread. I'm not allowed to talk about pickleball because I get in trouble for that regularly. I feel like it's the old adage of someone's into CrossFit or a vegan within minutes of meeting them because they'll tell you. Same thing goes for pickles. So I too feel just like a guy at the end of the day, and you're super humble, Philip. Senior portfolio manager for the team. This is a nostalgic moment for me. I know you said Word on the Street. That was a little content series we used to do back in the day. For those watching that don't know, Philip had moved on from Warren Street for a number of years, went on to Capital Group and filled a number of different roles there, and is back on the Warren Street squad. And this is the first time we're sitting down to just kind of really cast our perspectives on where we're at markets-wise, kind of perspectives going forward. And I hope this is the first of many. So most folks watching this today will likely be doing so at our annual client appreciation event. We're expecting over 200 people, biggest number yet. And then for those who can't watch there, we'll certainly make this available, to consume at their leisure. So I'm excited to be here. We're just going to kind of riff. We don't want to be overly stiff and formal and sterile. We're going to show a number of charts and just kind of, again, try and give, the audience a general feel for how we're thinking about the markets today, both in terms of what's happened this year and potentially a little bit of what we expect going forward. You and I both know we try not to have crystal balls, try not to make short-term forecasts because they oftentimes tend to be wrong. But we'll do our best to kind of give some color to how investors might think about the markets, the opportunities at hand, and kind of how to behave in the market cycle ahead. So excited to be here with you.
Now, today on the show, we're largely going to be talking about the market update, right? How different asset classes performed year to date so far. What do we think about the S&P 500 hitting all-time highs in the face of everything that's happening in the world? We'll also take a fun trip down memory lane where we'll talk about eggflation, right? Who remember when that was a thing? And maybe I went out of order a little bit, but we'll also touch on, at one point, key events that have probably made it to our clients' headlines, right? Such as the US dollar, the debt downgrade, etc. So a lot to look forward to.
Let's dive in. All right, so first chart we're going to bring up today. I feel like this is a narrative I wish would have occurred sooner. It's something that we've been talking about for a long time, which is international stocks finally serving a purpose or a function within a client portfolio. Take me through just kind of year to date, the story behind what's happened, geographically across the globe and maybe across asset classes.
Yeah, so this chart we have in front of us here shows a number of different asset classes and the returns from the start of this year till mid-July. And I think there are two really important themes that define what's happened so far, which is number one, there's been a pretty big reshuffling of market expectations across asset classes. You mentioned international versus US. We'll touch on that very shortly in this same slide. Then there's also this second theme where it's been very important to maintain a global perspective, and diversify the portfolio not just regionally, but also across different asset classes, right? It's not just buying stocks and bonds, but maybe buying something that behaves a little bit differently during different periods of time. And I think there's a great example of that with the top performing asset class on this chart to the far right. You have gold taking the gold medal, so no pun intended, but 27% year-to-date return, which is a lot. And there's a myriad of reasons driving that, right? You can call it US dollar weakness, geopolitical uncertainty, even foreign reserves, right? Playing a role into other nations buying foreign reserves of gold rather than buying different currencies or whatnot. So I think that all has driven gold's asset class performance. But really, gold is one of those asset classes that behaves a little differently, right? It isn't directly correlated with your traditional stocks and bonds. It tends to swim in another direction when some of these asset classes behave otherwise. And this is a year where investors who have held gold for those diversification purposes have really been well rewarded so far.
Mm-hmm. Tell me a little bit about what you see within just the geographic breakdown of the equity markets. So U.S. markets, both large, mid, and small, and on to their international counterparts. Kind of what are you seeing?
Yeah, so I'll start with the U.S. markets. This year we're seeing the S&P 500 returning only about 7%, which is pretty stark compared to its performance from last year. And then we also see the smaller scale, small caps to the far left of the chart underperforming this year, returning negative 0.4%. But really the interesting thing that kind of takes the cake this year is international stocks. We've seen international stocks return, call it 18% or so, relative to the S&P 500, 7%. So that's an 11% outperformance. And it's just something that I'm curious how you feel about it, right? You shared a little bit of sentiment at the beginning. I'm curious if you feel any retribution or final validation after all these years of harping on avoiding home country bias or whatnot.
Yeah. I mean, we talk about this often. The thing I've had to apologize for most in my career is a willingness to own stocks outside the United States. So just international investing in aggregate has been an unpopular thing. Or I guess a thorn in my side is probably the better way to put it. I don't think I'm taking a victory lap by any means. I think we've got a lot of ground to make up, from prior years, and hopefully this is just the green shoots of things like valuation starting to matter, fundamentals starting to improve, and the U.S. not necessarily being the only game in town. So like 18.5% year to date in European stocks, relative to let's call it 7 in U.S. large caps. If you look at actually our largest international manager, Oakmark historically, which is like a deep value manager overseas, up over roughly 25 to 27% last I looked year to date. So an order of magnitude even greater. By no means do I pretend to know what's going to happen in the next 6 to 12 months. But you are starting to see, hey, can the rest of the globe compete for returns, for investment dollars? And you don't know where the returns are going to come from. Is it from prices expanding? Is it from earnings expanding? Like, where is it going to come from? There's a little bit of a perfect storm afoot right now, both in the developed and the developing world. So I'm hoping that this is not a short-lived experience and that you actually see diversification start to matter and to win again. I got tired of calling it diversification. And then on the gold front, you touched on it a little bit, but at the end of the day, gold we've often thought of as like this crisis commodity. It's a place where dollars go when maybe there's a distrust in market structures or in broad economies or in sovereign currencies. And you've kind of had a little bit of all of that in recent years, not necessarily all at once, but in the US in particular with, US credit rating downgrade, with dollar dominance potentially starting to fatigue a little bit, lack of certainty with respect to the Trump administration and how they're handling their tariff policy and kind of their trade deals. You saw dollars looking for another home that wasn't US Treasuries, right? And some of that made it into crypto, some of it made it into gold, silver, so on and so forth. But there's this kind of like agency effect going on where it's like, whether it's a sovereign investor or an institutional investor or even a retail investor, for the first time in a while, they're not necessarily thinking of treasuries as the safest bet in town. And not saying that is the right read necessarily, but you have to actually think about it, right? And it's not just because of default risk, it's because of interest rate risk. Fed might have been cutting rates a little bit, market kind of yawned, 10-year treasury has remained very, very sticky and stubborn. So it's just been a really, really interesting year, and I do celebrate a bit that diversification is helping, right? Because it's hard to preach it as a practitioner and see it not add any value to the end investor's life. And people get frustrated, and I don't blame them for it one single bit.
Yeah.
But the moment we can show them, like, hey, first couple of months here in the US were really tough this year, you're up, you're positive, or you're doing well, or you're doing better than the average, and here is why. It really drives home kind of what we've been preaching for a number of years, which is avoid home country bias, have a willingness to look a little bit different.
Yeah, absolutely. I'll say one thing on here, then we can move to the next chart. But I think your point about, hey, international offering that diversification is key, because our international allocation this year isn't because we've chased returns and we're chasing the hot dot here just because it's doing well, right? We've allocated this to get an international mix of assets to help cushion when there's volatility at home, such as what we've seen over the past 7 months or so. And its role is also meant to smoothen out your portfolio as a ride over your journey. So I feel like international has been able to help do that for us this year. But I want to talk about the S&P 500, because even though that's a 7% versus 18% return for the US versus international, the S&P 500 keeps hitting all-time highs like we see in the news. So our next chart actually takes us through a really quick recap of the S&P 500 from the start of this year up until middle of July. And just to give everyone a quick rundown, we're not going to spend too much time, but we started this year, a lot of people are optimistic about American exceptionalism continuing its trend. And then you had in late January the DeepSeek market shock, where DeepSeek basically came out and showed that with 2 sticks and a piece of bubblegum that it could make something that was just as good or even better than the likes of OpenAI's large language models. So you had that market shock, and on that day, NVIDIA dropped about 17% or so. Markets kind of shrugged it off a bit. A few months or so later, or a month later, about S&P 500 hit an all-time high. I think that was a point where I was starting to pay attention to the markets, and it really felt as if the markets were priced very expensively, and they were kind of looking for any reason to pull back. That's when you had all these tariff escalations come through, right? Like President Trump coming in, initially escalating tariff tensions with our trading partners directly with Mexico and Canada. So you had a bit of a drop off. Then you had an even sharper drop off come Liberation Day, 4/2 in the Rose Garden with the boards, tariffs on a variety of nations, even tariffs on penguins in Antarctica, something to say. And then eventually we paused there. Markets kind of recollected themselves, and ever since then they haven't looked back. We've made market highs, and it's really just been perplexing to me because we're back at all-time highs, but we've got 10 to 15% tariffs on multiple trading partners, 25% tariffs on autos, right? 25% tariffs on steel and aluminum, yet markets seem to be shrugging that off.
Yeah, I think at the end of the day, we've talked in prior content pieces around markets tend to go up regardless of who's in office and what administration's in effect. Capitalism and capital creation is a powerful force. It can cut through a lot of noise and a lot of uncertainty, even in years like this one, right? So I'm going to maybe unpack a couple of these different market events from DeepSeek to some of the tariff kind of tensions that have occurred. I think with tariffs, if you saw the quote unquote Trump trade leading up to Inauguration Day, the general premise or consensus was broad aggregate U.S. leadership, very bullish, in particular for small and mid caps, because of like this onshoring, reshoring kind of narrative of like we're bringing business and manufacturing back home, and we're going to be, very much so almost protectionist in terms of domestic industry. Well, the worst performing market segment has been U.S. small caps year to date. So a lot of what the market maybe was pricing in and expecting got turned on its head by what sometimes has felt like arbitrary or half-baked kind of tariff policy. Now, the reality of most of this tariff policy is what's been drawn up or teased out hasn't actually gone into effect, and there hasn't been really teeth to it just yet. You also have the taco or chicken out kind of mantra for Trump, in the sense that like this is leverage, this is posturing, this is meant to motivate new trade deals and create pressure on trading partners, which is certainly a possibility, even if it's not intentional. You could see that potentially play out. So the market is, again, discounting the noise and what it seems like getting back to its expectations with respect to fundamentals, investors' appetite for risk, all of these different things. So that's a segue into DeepSeek and what's going on with AI. It's my firm belief that the market's been dominated by U.S. large caps. And within U.S. large caps right now, you're hard pressed to listen to an earnings call not dominated by what's going on with AI. And that's every single which way AI might proliferate a business. Expand productivity, efficiency, margins, new business lines, you name it. It's everywhere. And the market, I think, at the end of the day, is pricing that in. It's what will AI do to revolutionize our business? Yep. And I don't disagree that AI, I think, is very bullish for capital markets. I think it's a whole different set of facts and circumstances for labor. And so you really do want to own stocks, and that will participate in this kind of AI revolution, and making companies more profitable, so on and so forth. But when you see something like DeepSeek come online, where it's like, oh man, is AI going to proliferate in a way globally that maybe Web 2.0, Web 3.0 did not, in terms of the internet and e-commerce and Amazon and content and Netflix and all these things? Will AI be a bit more of an even playing field with respect to Europe and Japan and obviously the developing markets? And when something like DeepSeek comes out, and like you said, can be kind of spun up with, much less budget, much less compute, all of these different things, it throws a genuine shock into the system of like, oh, maybe we won't hold captive. Maybe the US markets won't hold captive all the accretive kind of potential that AI might offer to US corporations. Something as simple as an NVIDIA, right? Like they're selling so many chips and GPUs, and in order to kind of stand this whole thing up, from OpenAI on downward, and then DeepSeek comes along and says, oh, we can do it with so much less. And that gets priced into NVIDIA's pricing model, right, to kind of arrive at what they're worth. So you said sizzle to fizzle, back to sizzle. I've heard, this is a head fake market. It is a melt up market. I think they're all kind of true in a way. And in order to continue producing all-time highs and continuing this trend upward, especially with hopefully dampened volatility, AI has to deliver. The amount of money companies are spending on AI, R&D, et cetera, needs to start to show into the bottom line. And there's a meaningful risk that it won't. Not saying that it won't work and long-term have legs and all that stuff, but will the ROI be there? Will companies have spent wisely in terms of how they're allocating capital and how they're kind of embedding AI within their businesses? So, I don't think I thought beginning of year we were in for the type of volatility that we thought, and almost similarly now, I don't think we're in for this rosy scenario into the year finish, especially within the US markets, but the future is very much so unknowable, especially in these 6-month kind of market segments. So I'm not exactly lamenting the fact that we're at all-time highs. I'll take it, and I know most of our clients will too.
Yeah, no, absolutely. And I'll say one thing about the whole AI craze, where you're right, there's been little mention of ROI, return on investment, in these companies' earnings call. And it seems like a lot of the focus has been a lot more so on what are you doing with AI? How is that transforming your business? Are you building something for consumers? What about your commercial applications, right? And the focus has been less on what prior quarters earnings will be, but future guidance, like what are you going to be bringing in with AI moving forward? And we just don't know how much of that will actually be actualized, right? Mm-hmm. But at the same time, there is a world where we have to spend as much as we are spending on AI, even if we're not certain about that ROI, because the rest of the world, we don't want to fall behind them.
Yeah, so it's like a sneaky arms race at the end of the day, because AI and robotics and just autonomous driving, there's elements of this that have defense implications, biopharmaceutical implications, there's no end to it, right? And so we have no choice but to spend and to try and keep up and innovate. That does inject a potential for volatility if we aren't doing it right or well and executing. That's one more reason to potentially be a little bit wary about kind of where the U.S. market stands today.
Absolutely. And I think the next chart really highlights not just the high level, but gives us some perspective about how the S&P 500 is trading relative to history. Is it cheap? Is it expensive? So what we have here is, this chart seems like there's a decent amount going on, but bear with me here as I walk everyone through it. What we're doing here is we're charting the S&P 500 level from 1997 all the way up until June of 2025. And we're basically playing connect the dots, one of my favorite childhood games, from every peak to trough of the S&P 500. So we're playing connect the dots at the top and the bottoms, and then we're showing what was the return after every peak and every bottom. So just to walk everyone quickly through this, in 1997 up until, call it early 2000, the S&P 500 appreciated about 100% or so. And then from, call it 2000 to 2002, during the dot-com bust, you had about a 50% downturn. And then you had an increase about 100% from 2002 to 2007. And from that point forward to 2009, investors experienced the great financial recession, where they lost over about half their money, or 50%. But after 2009, that came the longest bull market in the United States, where we returned a whopping 401% on the S&P 500. And that was shortly followed by COVID, kind of that whipsaw effect where markets are down 30%, but up significantly during that same year. Between that bottom and the next top, you returned about 100%. And then in 2022, you fell 25% as the Fed raised interest rates to combat inflation. And market seems like it's kind of looked back a tiny bit with the tariff volatility recently, but it's made its way back to new highs, right? Having returned 73% from that last bottom. So quite the journey for this chart so far. Go ahead.
Nothing, yeah. I think I'll have a few things for you in a moment, but finish your thought.
Absolutely. So in addition to playing connect the dots here, at every one of these peaks and bottoms, we've overlaid something called the forward price to earnings ratio. And what this basically measures is how much are you paying for $1 of a company's future earnings, right? Another analogy could be, price per square foot. You're assigning $1 to something you deem to have value, or 1 unit of something you deem to have value, in order to gauge, hey, is this expensive compared to other countries? Is this expensive compared to history? And what you'll notice here is that prior to every market downturn, the forward PE has been relatively high, right? And prior to every bull market, the forward PE has been a bit lower. So this tells me a number of things, but I know you're kind of itching to jump in here, so I'll let you cover some of the points here first.
Yeah, I think just reminding our clients like why we invest, right? When you invest in the stock market, you're an owner. You own a corporation, which means you own its success and its failures, and those are usually measured by the profits they're generating, the profits they will generate, or the money that they'll lose, right? And so we're obviously all rooting for paying a reasonable price for the earnings a company is generating and hoping that they generate even more into the future. And so that's the basic function of a price to earnings multiple or a PE ratio, is to understand how expensive is it. So 22 times, if you just think about that, compared to all the other peaks here modeled out, really the second most expensive reading, with one exception, which is kind of the tech bubble. So I actually want to go back to there and just talk about like investor psyche, investor psychology, because I think we all like our eyes get wide as far as look at that return period between 2009 and 2020, that really broad, uninterrupted bull market. But I want to take you through just like investor psychology of what it might have looked like to get there. So, pretend for a moment you invested, in the late 90s and you caught the top. Not necessarily you invested everything at once, but you caught the top in the sense that you were kind of late to the game and you were all in stocks and you lost half your money. You rode the wave, right? You're down half. You see, between, market bottom and let's call it bottom trough of 2009, so March of 2009, you lost another 50%. So you lost 50, let's call it, make 100, and then you lose 50 again. You went nowhere. We call these the zombie markets, so the zombie decades, and we've seen other geographies suffer this for even longer periods of time, like Japan. But in the US market, you effectively went nowhere for 10 years. I fancy myself as a very informed investor, very rational, and I think a good grasp of not everything always goes up, and patience wins, and just keep buying, buy the dip, all these different things. But I don't think any human on planet Earth can honestly, look themselves in the mirror and say, I'm willing to ride 50% down, 100% up, 50% down again, get back on the horse for 10 years, risk on to try and win that 400% return. It's obvious in hindsight because it occurred, but just put yourself in that position of like being an early days investor, saving for retirement and having that experience, how hard it would be to commit yourself to like the long-term philosophy of staying invested. So fast forward to today, at 22 times. Now this is just the US, the rest of the world doesn't necessarily look the same way. And this is the US large cap markets. What does this tell you? It tells you that things are somewhat priced to perfection and are rich. Markets have a tendency to get more expensive when they're expensive, right? And that's how we go all-time high to all-time high to all-time high. But I think there needs to be a certain semblance of risk management in place, meaning not being all in US large cap stocks, which has been a really hard story to sell because folks have just seen for 10, 15 years this US large cap market dominance. And the problem is if and when it stops, it will be painful, right? And so right now you're seeing an asset rotation or a market rotation in terms of geography leadership. You're not really seeing the P in the PE multiple contract, which is investors' appetite all of a sudden disappears. They're willing to pay less for the same dollar of earnings. You're not yet seeing the earnings contract. And so if you see those two things happening at the same time from a fundamentally high starting point, that's when things get relatively ugly quick. And I think these like short-term head fake market corrections where market sells off 15, 20%, and then all of a sudden we're back to an all-time high within 3 to 6 months, actually is doing damage to people's investment discipline because they get so rewarded for buying dip, rotating, rebalancing, et cetera. And they're like, ooh, this is so easy. I know what to do the next time. This isn't always how it plays out, right? So you still need to have a willingness to like, what are your short-term reserves? Where is your retirement income generation coming from? Where's my dry powder? What is my plan for, God forbid, U.S. market leadership stops, right?
Yeah.
That goes back to the other chart in terms of willingness to own other stuff. All right, let's jump on to the next chart.
Yeah.
Is the valuation level of the S&P 500 justified? How do we make sense of maybe the underlying constituents within the S&P 500? And just to recast for the audience, S&P 500, just the largest 500 companies in North America. there's a lot of different companies in there, a lot of different subsectors, industries covered. Where are the valuation pockets coming from? How should we be thinking about it?
Yeah. So it's interesting. On the chart here on the left-hand side, we actually have broken this down by the top 10 stocks in the S&P 500, the remaining 490, and then we're showing the S&P 500 level itself. And what this shows here is that forward price to earnings ratio that we had talked about earlier. And I think it's super interesting because the top 10 names, sure, everything's trading at a premium, but the top 10 names are trading at a much larger premium than the other 490 stocks or even the S&P 500 in aggregate, right? So 28.8, call it 29 times against 21 times. Wow, that's expensive for sure. But it's not just these top 10 names that have a premium to market cap too. Or sorry, that have a premium in the forward price to earnings ratio. The top 10 names are also making up a sizable chunk of the S&P 500 itself. In the chart on the right-hand side, we show how much weight is the top 10 names in the S&P taking up. And we can see that during the dot-com bubble, that was anywhere between, call it 25, 27% or so. But more recently, the top 10 names account for almost 40% of the S&P 500. Think about that, right? 10 names, 40% of the S&P. Those are some sizable numbers.
Mm-hmm. With respect to I was actually surprised by the chart on the left, because if you take chart on right and you think about just market constituents, 40% roughly of the index being made up of just 10 names, in order to get there, you think to yourself, those top 10 have to be so much more expensive than everything else. And arguably they are, in the sense of 28 times forward earnings compared to the broad index at 22. But they're all expensive relative to themselves, right, in terms of recent history, which just goes to show that there's a lot of, I'm not going to call it lazy buying, but it's just habitual buying of people buy the S&P 500, very little friction, very tax efficient, easy to access in terms of market structures. And so the bid is almost always there, right? And the bid has been there for quite some time, and the bid is growing. When I say bid, I just mean the buying pressure of, the stock market at the end of the day is an auction every single day. People buying, people selling. So the buyers are just bidding and providing that liquidity on a daily basis. So they haven't seen anything that's necessarily given them pause to really undo that kind of expansion or the multiple expansion. And at some point, maybe they will. Maybe they'll have enough, or they'll see enough to where the bid will disappear or will weaken. But this just goes to I think drive home a couple of things, which is, yes, we have general concerns around home country bias of people chasing U.S. large cap dominance. And we certainly have a concern with people chasing the concentration within, and the fact that 40% of the index is made up of just 10 names. If you go back just less than 10 years ago, that number was close to 15%. And obviously there's a correlation. You look at the green line, that's a measure of how much earnings are being produced by these companies. So it's not as if this is a speculative trade. You compare this to the tech bubble, where there was very few companies obviously being traded on at these crazy multiples, and they were a lot of them in some cases pre-revenue, pre-earnings certainly, or pre-net income. Contrast that with today, which the top 10 in the S&P 500 are titans of industry making fistfuls of money. As you see here, the broad representation of the profit being generated by the index. So they should, by definition, make up a large constituency. But if you go back to what we talked about in the last slide, about AI and proliferation, downstream, making other companies more scalable, more profitable, et cetera, overseas, small and mid caps, when you start to see that earnings production potentially level out, that's one more reason why the top 10 could potentially have some downward pressure on them. Also, big things getting bigger. Bigger companies are hard to manage. You get market saturation at a certain point. You have more competitive threats out there, unless you kind of have formed some type of monopolistic kind of structure that keeps other entrants from coming in. But if all of a sudden you saw this green line go the wrong direction, at the same time investor appetites are changing, that's when you got real trouble. Because the earnings are no longer there, which is the bottom of PE, and then the price now all of a sudden is chasing downwards too. So yeah, I've seen this in various forms over the years, and the market continues to yawn at me and just go higher. But at a certain point, this type of concentration will matter, which is why we're really encouraging clients don't chase the FANGs or the Mag 7s, and certainly have a willingness to own some other stuff out there.
Yeah, absolutely. And I think it's interesting to me because you're right in the fact that even though these are great companies that have generated a robust amount of earnings, right? This concentration in the S&P 500, as we've seen from this chart, it isn't necessarily unfounded because there is real earnings growth that has supported these companies. But it's also a bet moving forward that that earnings growth is going to persist and expectations are going to be met. And with a world where, you know, there's a lot of cloudiness or murkiness with AI, I think you have to kind of take a step back and ask yourself, like, hey, am I comfortable with things potentially being priced to perfection, as you mentioned, or do you want to try to diversify away, you know, overseas? That, and also some of these companies are great and big, but they're not big enough to defy gravity, right? So nothing will keep going up forever. You know, Newton's law, whatever comes up must come down at some point. Again, we're not calling this as a bubble, but it's more reasons for us to maybe take a pause before we just recklessly plow money into something like big tech.
Mm-hmm. All right, let's jump to the next, which is the other side of the sea. Back to international, kind of where we started. We talked a little bit about S&P 500 concentration, valuations relative to historical norms, concentration of top 10 names. How do valuations differ overseas? What are we seeing in developing world? How should we think about valuations, you know, relative to U.S. markets, relative to, you know, their own historical norms? Walk me through what we're seeing here.
Yeah, absolutely. And your question is basically, what does that forward PE multiple look like in different areas of the world? And this chart gives us a range for that. So it shows us for the number of regions on the x-axis, what has that range of the forward PE been over the past, call it, you know, 20 years or so? What is the average? So that's a lighter gray rectangle, either in the middle or on the lower ends of these bars. Then you've got the current forward multiple in purple and what it started at the start of this year in blue. And what we're seeing here is really, in the United States, the forward PE is trading at the top end of that range and well above its 20-year average. And across the other parts of these geographies, it's really trading around the longer term averages, but also well within bounds of the entire range. So there's a lot more room, I'd say, to be able to say, hey, valuations in different areas of the world are cheaper than the United States. One to highlight here is the Eurozone. So I think for the longest time, we've seen that forward PE multiple actually trade below the 20-year average with recent flows. Again, that's kind of made its way with multiple expansion. So the price, as a part of that, price to earnings ratio has made its way up, as well as some aspect of earnings. But again, they still trade well below the top of those ranges, which is something to consider.
What country or geography, region, etc. on here do you think is most striking to you?
That's a great question. I want to say China, just because for the longest time ever, I think you had a good series of investors talking about, hey, emerging markets asset class, you know, middle class growth. China also had the Alibabas of the world where people were kind of likening their big tech versus the US big tech and real earnings growth to be had from there. So obviously there's been a myriad of things kind of go wrong with China, ranging from zero COVID policy, really limiting economic growth. You have things like property bubbles that have impeded the economy's ability to grow altogether. So I'm a little bit surprised that China is trading below its average, but more recently, I think there's reasons to be bullish with the Chinese government saying, hey, we're going to announce fiscal policy in order to stimulate a lot of these sectors. We're going to be able to bolster AI, bolster green energy and infrastructure. So there seems to be an actual catalyst also coming from the Chinese government to help financial markets. And we actually do see fund flows chasing China, as we've seen with recent fund flows entering the Hong Kong Stock Exchange. And overall, the asset class has just grown in popularity over the past 6 months or so.
So I know PEs or almost any valuation metric can be kind of noisy in the short term, which is we try not to use them necessarily as like short-term timing tools. There is a more longer-term smoothed out version of price to earning ratios. We've talked about it in prior content series in the past. That's known as a CAPE ratio. And effectively, it's just a longer-term perspective on a company or a country or a particular index or market's earnings. So oftentimes they're 10-year smoothed averages, which gives you a better perspective of kind of like in what decile or percentile is a country currently relative to their historic norms. There isn't a huge decoupling in terms of what you're seeing here with shorter term PE ratios relative to capes. But what I would say is the orders of magnitude are even greater, which is the US is, on a cape ratio basis, perceived to be even more expensive relative to itself, relative to other kind of market segments. And some of these foreign markets are still, even though they've performed very well year to date, like bargain bin cheap, right? And so what's hard with this is, we have a little bit of career risk embedded in the sense that like our clients know US markets. It's what they hear about in the headlines. It's the water cooler talk. If I sat down with a client and I said, hey, the US is trading at 22 times, with a long run average around 16, and China is trading at, let's call it 10 times, or 11 times rather, with a long run average around 11, and then giving them a feel for the upper bounds. Same thing with Japan, like this is how high it could have been. So my takeaway is let's buy only cheap stuff. Let's load up on China, let's load up on Japan, maybe a little bit of the Eurozone, and kind of hold our nose. There's a tremendous amount of behavioral risk, career risk kind of embedded in that kind of talking point. And that's not what we're expecting our clients to do, right? And they would have been materially harmed by doing that in the last 5 to 10 years. So this just goes to say expensive stuff can get more expensive. Cheap stuff can get more cheap. Because at the end of the day, fundamentals attract dollars. And so we're trying to just bring some attention to the fact that at a certain point, when fundamentals start to revert, the stuff that's been crushing everybody starts to get softer. The stuff that's been soft starts to find its footing and starts to go the other direction. There's a time where it pays to be a bit strategic in the sense that like, okay, I can now mute some of my bias, home country bias in particular, and have a willingness to maybe kind of jump into that bargain bin. Thankfully, a lot of our clients have allowed us to do that for them. And they've been very, very much so rewarded this year. And my hope is that we're at the beginning of a market turn where they're going to see kind of some of that international diversification kind of pay out for years on end.
Absolutely.
Next chart, looking beyond U.S. growth assets. Take us through kind of what we're seeing here, both kind of in the regional level and then maybe some of the underlying sectors or kind of themes within those more regional themes.
Yeah, absolutely. So on the left-hand side, we're basically showing the performance of different regions. So Europe, Japan. Then we have the S&P 500 excluding NVIDIA. And what you notice here is that Europe and Japan, since the market bottom in October of 2022, Europe and Japan have actually outperformed the S&P 500 ex NVIDIA by a pretty wide margin. And that goes to show just how concentrated market leadership has been within the United States, right? Those top 10 names we had talked about and that level of concentration. Really, when you're investing in S&P 500, a good chunk of your bet is in those names. So any volatility with those 10 names can lead to sizable differences in returns.
All right, let me stop you real quick. So this is from market bottom in 2022, which was a terrible year for stocks, through today. We're looking at the aggregate of Europe, the aggregate of Japan, relative to the US, excluding one stock, NVIDIA. And that, I think this just drives home like that concentration problem that we've talked so much about, which is just think about how silly of a phenomenon that is. Like I can own a broad-based diversified basket of all European equities or all Japanese equities, and or I can own the S&P 500 excluding one stock, and look what it gets me, right? So it's really hard to know what that one name is that will win the day, which is all the more reason I think to index or own broad-based diversified portfolios. But it just does go to show you how one singular stock that's already a concentrated problem can drive so much of the ultimate outcome, which, if we just modeled that during this DeepSeek little tantrum and sell-off, how damaging that was to the US market, it shows you kind of how this can go the other direction as well. So I mean, if you told me without the labels on here what I'm looking at, I would have had no idea, but that is pretty powerful.
Yeah, I thought it was a pretty striking figure or striking data.
I think I'm more struck by the right side. Okay, walk us through what we're seeing on the investment theme side.
Yeah, so this just goes to show, since that same market bottom, what are some broader investment themes beyond U.S. growth, right? That gray line, and how have those performed? So you've got European aerospace and defense really leading up the way here, and That's largely in part due to Ukraine-Russia happening, a lot of European nations coming out and saying, hey, we've got to fortify our own defenses and we've got to be willing to spend on military and ultimately, defense spending. So you have the likes of European aerospace defense really leading the way. You've also got other themes like international developed market banks, Taiwan technology, India consumer discretionary, all competing with the likes of U.S. growth and performing either similarly or better than U.S. growth since that October market bottom. And that's interesting to me because, again, U.S. growth is what had driven a majority of U.S. returns over this past decade, right? Everyone's talking about there's no place to be other than the U.S., but particularly there's no place other to be than the U.S. growth, right? So to me, that just goes to show there are other catalysts and other themes that are proving to compete with what had been the leader for the past decade.
Absolutely. And I think the reason I'm most struck by this is, the second one on there, developed market banks. European banks have been in the doldrums, like probably one of the worst performing themes of the last 15 years. And we've opportunistically bought a bit of European banks, whether it's in a fund structure or a targeted kind of theme. And it felt like the thing that was just plain dead and that we were poking for forever. So to see it outperforming U.S. growth going back to the fall of 2022 was pretty powerful. Taiwan tech couldn't be any more different than developing market banks. And then aerospace and defense in Europe. So you made the comment about Russia and Ukraine. The general responses around kind of NATO spend, what percentage of GDP are all kind of NATO countries going to participate and kind of get their budgets up to. We're talking multiple percentage points in each underlying kind of player now being committed to aerospace and defense spend, which is bullish certainly for the publicly traded companies that kind of play in the sandbox. So I think it's cool to see very unique themes and or sectors or industries having some time in the sun over U.S. growth and not necessarily having it be just one particular pocket of the market that's like a hot dot that's being chased. So I think this signals strength in the sense that it's like it's broad-based, there's a lot of breadth kind of behind it. Question is, how does it hold, right? And how does it manifest in the years to come? All right, let's switch gears. We've been talking a lot, just market-centric stuff, asset classes, returns. Let's talk a little bit more just broad economy. Hard to escape the conversation around tariffs this year, even though a lot of kind of what's been postured might not necessarily have taken effect, and there's a lot left to be seen and learned with respect to kind of what the ultimate trade deals kind of look like. But just give me a general kind of sense of where we're at today in terms of where we come from, where we are, and how maybe it's affecting confidence in the underlying economy.
Yeah, I think tariffs are really the boogeyman of the markets, right? Spooking them out. But we started the year with the average effective tariff rate sub 5%, and at one point we had that shoot up to north of 25%, almost 30% after Liberation Day, right? And during that time, we're even talking about having potentially 140% plus tariffs on China. A lot of that has come down since then. As we're recording this on July 29th, the administration's announced new deals with the likes of Japan, the Philippines, Europe even. So it really does seem as if the new baseline for tariffs is going to be more so around 10 to 15% across the board. And again, it'll just have to vary by country. But I don't really think it's the absolute rate of the tariff that's causing the spookiness for markets. I think it's the uncertainty around tariffs on, tariffs off, then on again, right? What is going to happen next? So it's kind of hard to, if you're a business, right? Let's say you're a bicycle shop and you're trying to decide, should I open a new store? Should I hire more people? But you don't know if the cost of your import is going to increase. Well, you don't want to be caught in a position where maybe you're shorthanded on cash to pay your employees because the price of making your product went up. Or maybe you don't want to be caught in a position where you're at a cash deficit altogether when it comes to investing because you overinvested to pursue your growth ventures. So it just leaves businesses grinding to a halt and really uncertain. And I think that's where a lot of that market uncertainty really stemmed from with respect to tariffs.
Mm-hmm. Tell me about the right side in terms of, you kind of gave the analogy of the bicycle shop, but maybe in more aggregate terms of like how public perception, how is it bearing out in the data?
Yeah, I'd say the right side, I'll start there, is a chart by the Federal Reserve Bank of Atlanta. And what they did was they did a survey across a number of different businesses, about 1,000 businesses participated, and basically asked them, hey, based on policy, which we know right now is very uncertain, whether it's fiscal, monetary, etc., what are your plans for hiring? What are your plans for future investment? And they found that a whopping over 40% of businesses announced that they're going to scale back hiring. 45% announced that they're going to scale back investment. So that really goes to show, hey, they're really stuck in wait and see mode, right? It's really hard for them to take a next step and invest in themselves and therefore invest in growth, which would bolster the global economy.
Understood. I can tell you from the conversations I have with business owners, regardless what side of the political aisle that they fall on, the uncertainty, almost in the same way we talked about investors valuing certainty, it's the same thing that business owners value, right? Because when you gave the analogy of the bike shop, is it just accept slower growth? Is it pass on prices? Is it seek out new supply chain kind of offerings? However you kind of cut it up, it's disruptive, right? And if at one day it's X and the next day it's Y and the next day it's Z, it's just hard to plan, right? And it's hard to execute without a plan and at least some visibility as to what's going on. I have been largely not unimpressed, but I've taken a perspective of let's just wait and see with a lot of this stuff, because so much of the tariff posturing has been kind of a mutual path of destruction if things play out how they're kind of being articulated or kind of messaged in the public square. And obviously you've seen what's gone on with the Fed and interest rates, and Powell and Trump kind of being at each other's throats through back channels. But it is hard to fathom a world where some of the things that have been held out from a tariff policy perspective aren't inflationary, and how it doesn't in the short term hurt the U.S. consumer. So I think I'm somewhat relieved that the Fed is taking a rational kind of wait and see approach to just really measure the data of what tariff policy actually makes it into play. How does it actually affect end consumer prices? How does it bear out in the data? Because at the end of the day, that is their core mandate, or one of their core mandates anyway. So yeah, I don't envy business owners that have a material amount of import coming in where they're just constantly, they don't even know what are they going to wake up, what are they dealing with? And so it's definitely some uncertain times here, and I'm not surprised to see this bear out in the data. All right, tell me a little bit about what tariffs are doing, and maybe not just tariffs, but just current administration's perspectives on tariffs, deficit spending, big beautiful bill, kind of what effect is that having on the U.S.'s role in the global monetary system, dollar dominance, all of those things.
Yeah, and I think the U.S. dollar is a really good microcosm for all those things that are playing out. You have this year the U.S. dollar falling below its 10-year average when measured against a basket of other major currencies like the euro, the yen. So that's what we have on the chart here. You can see, dipping below that 10-year average. And you've probably heard a lot of these headlines make its way. We've shown some headlines on the right-hand side of this chart where, just to read out a few by JP Morgan, is this the downfall of the U.S. dollar, right? Dollar collapsed by, the hill. The crisis is no longer just theoretical. So there's a lot of noise with the headline, but I think the broader question we should be asking is kind of what you mentioned, which is the U.S. dollar and its status as a world reserve currency jeopardized? And I don't think so. And I've got a few reasons as to why. So first order of business is, or I guess in summation, you can think about the U.S. dollar as still the world's cleanest, dirty shirt. So maybe it's got a few more wrinkles, a few more rips and stains, but it's still better looking than Europe's shirt. It's still better looking than Japan's shirt. And here's just a few statistics why, right? When we look at the U.S. dollar against the next considered major currency out there, being the euro, and we look at this across some major trade or major currency statistics, we see that the U.S. dollar accounts for 50% of foreign global exchange reserves, compared to the euro accounts for 50% of export invoicing compared to the euro's 30%. And here's the big one. Almost 90% of foreign transactions are done in the US dollar. So yes, the US dollar has seen its amount of foreign reserves come down since the late 90s, early 2000s, from 70% down to where it is at 57%. But 90% of transactions are still being done with this currency, right? A lot of Latin American or even other nations' currencies and exports are tied to the US dollar because of that liquidity and that trust factor. So being able to say, hey, the US dollar, sure, it's got a little bit of weakness going on, but it's still the most liquid, most trusted, and most embedded currency in our world system.
Sounds like you're still pretty bullish and confident in kind of that U.S. dollar dominance, and it doesn't necessarily have to be an all or nothing proposition, right? If you lose some market share, it doesn't necessarily mean that everything goes to hell in a handbasket. Can we back up to the last chart, just in terms of kind of what's going on in the U.S. dollar relative to a broad basket of other currencies, and you have seen some relatively material weakness between today and let's call it the fall of 2022. There's a direct correlation there to international returns in equity markets. And that's because a company earns in typically whatever their local domicile currency is. And assuming you're not hedging said security, currencies can be a tailwind or a headwind, right? So one way to play lack of confidence in US dollar dominance is to invest overseas, don't hedge your currency exposure, and not only are you picking up the securities return, you're picking up whatever the currency return is too. So if you're buying European banks and the company returns 10% and the euro appreciates another 10% relative to the US dollar, that's just bonus table stakes. Now, that has not worked in that direction in the last 10 to 15 years because the dollar has kind of cleaned up shop. But if you do have almost a similar reversion to the mean and people becoming less reliant on the US dollar, and I want to take a second just to kind of highlight, there's always risks across the board. Some you can see, some you can't. But in this day and age where the US is somewhat engaging in a little bit more of like protectionist, isolationist policies, that creates a power vacuum for other economic players to make deals amongst themselves, to settle trade in other denominated currencies. And then you have this advent of digital currencies, whether it be stable coins or kind of sovereign coins. And then, obviously the stuff that people are tired of hearing about, like Bitcoin and Ethereum and Solana and Ripple and so on and so forth. So the world has an appetite for other answers to dollar-denominated trade. And it doesn't necessarily mean that the end of the U.S. empire is upon us. Yeah. It just means that the U.S. can't be lazy with respect to how it treats other trading partners, other economies, how it stewards and fosters itself from a debt perspective, a deficit perspective. Because if you are having your credit rating downgraded, if you are casting doubt in terms of your willingness and or ability to repay your treasury debt, or you're regularly engaging in hostile behavior towards trading partners, like you're almost giving them no choice but to seek out other options and other alternatives. And that's not just from a how do we settle trade, it's how do we store our reserves? Are we keeping them in our local currency? Are we putting them in US dollars? Are we putting them in gold? Are we putting them in crypto? And I don't think we're to the point of anxiety and hysteria and panic by any means, but the U.S. has to be mindful about like what actions it takes with the rest of the globe, because if we just box everyone else out, we're left out of a lot of meetings, a lot of trade deals, a lot of kind of discourse across the globe. And if the rest of the world's playing catch up, that might actually hurt us in terms of our position at the table. So a lot to be learned there. It's kind of been the 800-pound gorilla for most of my career. And I know you said cleanest dirty shirt with respect to the US dollar. The cleanest dirty shirt, first time I ever heard it, I think it was Bill Gross. I could be wrong. But he was talking about just the debt and debt levels to GDP, deficit levels to GDP. How do we stack up? This became a very popular phrase during the European debt crisis, where the peripheral kind of pigs countries were having to go through major fiscal austerity, and we would argue that we've got our own debt problem here domestically, but compared to everybody else, we're the best option in town, right? And I don't know if it's eerie is the right word, but it feels bizarre to me that 15, 16 years later, in some cases, we're still saying the same thing, right? So where are we in terms of debt? How should we be thinking about debt in terms of an opportunity, a risk? How are we dealing with it maybe from a legislative perspective? And I know this is an albatross of a question, so we can kind of maybe collaborate on it and kind of work our way through it. But at what point does debt matter in isolation? At what point does debt matter in terms of kind of the interplay across other countries? Kind of how are you thinking about the U.S. debt problem?
Yeah, and I think I'll start from trying to take the perspective of just everyday people, right? Like, you look at the headlines, and what you see is the debt problem isn't new, right? It's been here for multiple decades, as you mentioned, when you were kind of earlier in your career. But I think there is a big difference between saying that, hey, there's a record debt level versus saying there's an imminent crisis, as some of these headlines sometimes might be making it to be. So yes, we do believe, or at least I do believe, that the debt is something that deserves a lot more attention from policymakers and investors alike. But at the end of the day, whether or not it warrants a crisis moment, that's a whole different story, right? And we can look at the next chart, in my opinion, which kind of gives a little bit more perspective on our debt. So what we're showing here is debt as a percent of GDP rather than looking at it holistically. And we can see that we're not the only ones with a debt problem, right? Or quote unquote problem. Japan has 205% debt to GDP, even Italy, 131%. US is at 112% as of 2023. More recently, that number's around like 120% or so, with our US debt level being close to 37 trillion. Yes, there are concerns, right, with things like one big beautiful bill passing, and that potentially adding 3 to 4 trillion in your debt over the next 10 years or so. But markets, you asked the question, when does debt matter, right? Markets really care about not so much what the record debt level is, but more so what is your country's ability to finance your obligation. And we have seen the US be able to pay off its debt in times of inflation, in times of pandemics, and even during times of recession, right? So markets care a lot more about the economy and the prospect for the economy than they do for an absolute debt level. But again, that's not discounting the fact that we should be paying more attention to this. We should be, as citizens and as policymakers, thinking about things like, we're spending so much on interest expense, only second to Social Security, which itself is a different problem headed towards insolvency, right? How should we, as a country together, try to tackle this issue, whether it be less spending or trying to grow out of it? Like, what is kind of our perspective? I don't have the full answers to those questions, but it's just things to think about. But I don't think we're anywhere near a debt crisis as some of these headlines might be making it seem.
Just like you might think about, like on a household level, your credit cards, your medical debt, your student loans, your mortgages, like debt, if used correctly, is perfectly acceptable. But if everyone in the neighborhood is overextending, at some point, you can run into this almost like liquidity phenomena, which is like, oh, we overspent on a home and we borrowed too many money for too many toys, and now comes the unwind. And if everyone's unwinding at the same time, that means that there's not a lot of liquidity to kind of take on your pressure or your fire sale, and the fire sale gets worse, right? And so I don't think we can forever just hold our head high knowing that the rest of the world is also a mess and either printing or borrowing to kind of finance their own initiatives or objectives. But at the same time, like, it's not something where you need to be yelling fire in a crowded theater. Something that I do think right now is a bit more of like a timely concern is when we were running up record deficits and financing record levels of debt to GDP at near zero interest rates, there wasn't as much pressure in terms of the fiscal budget impact on a year-to-year basis as there is right now, where last I looked, I think the CBO stated that we're going to spend roughly $1 trillion in interest expense in 2025. That's a lot of money.
Yeah.
And that's part of the reason why I think Trump is creating some pressure around Powell to cut rates. Well, the reality is the Fed can do whatever the Fed wants to do. If the market doesn't agree and or price in the same way, interest rates can remain artificially high even if Fed funds rate is going down.
Yeah.
Right? And that's when you start to have a real problem, is this decoupling and lack of confidence in Fed independence. And all of a sudden you have, if you're having inflation while there's a rate cut kind of regime happening, but actual rates are staying sticky high, debt levels are rising because there's a lack of perceived confidence in the U.S. system and the ability and willingness to repay, that's when you run into real trouble, right? It's like your debt is, you're incurring more debt and you're having to pay more interest on the debt that already exists, right? And that's why just financial stewardship matters, both at the individual household level all the way up to the elected, legislators and officials and executive functions of our government. So at some point, we think about record levels of borrowing. We think about what went on with COVID, where we overnight effectively printed a third of our money supply. We welcomed in this inflation and then acted surprised by it when it happened. All of these things are effectively borrowing from the future, right? And what generation's problem is it to solve, right? And so that's my greatest concern, and maybe I'm biased by being, a parent to two young children, is At what point do these things does the belt have to get tightened, and who's the one that has to tighten it? And that can be in the form of like, we don't have the money to cover people in health insurance and get more people covered. We don't have money to offer student loan forgiveness. We don't have money to stimulate housing markets and make it easier for people to borrow for their first time homes. We don't have the ability to offer, lower and middle class tax breaks because we can't just offer any type of deficit spending. And then obviously you can run with that, much further from there.
Yep.
So the concern is at some point it becomes somebody's problem. Social Security included, right? Like if all of a sudden we're offering more tax perks or tax-free Social Security, that was a little bit more of a nothing burger than I think it was held out to be. But Social Security has actuarial concerns long-term about ability and to pay its obligations. Someone at some point is going to have to deal with that. And that is in the form of means testing it or changing the age at which you can collect or changing the benefit formulas or increasing taxes. There's all these different levers that can be pulled, but it's just not a very popular thing to talk about. So do we want to deal with it when it's like kind of painful, or do we want to deal with it when our limbs are literally falling off? So I vote, let's get serious and be adults and deal with it earlier on so the rest of the world trusts our ability to govern and function and pay our debt. We'll see. All right, continuing kind of on just broad economic theme, I want to get a little bit lighter, more concise, so we'll move through these relatively quickly. Let's talk about the labor market, kind of what is big picture, kind of what are you seeing, what's the data bearing out?
Yeah, from a labor market standpoint, the consensus across markets right now is that the labor market remains strong, but there are signs of slowing down. So if you compare the unemployment data from this point in time to around this time last year, you do see a little bit of softening. The unemployment rate went from 3.5% to 4% around now. You do see increase in or a decrease in private sector jobs. You also do see the labor force participation rate having come down a little bit. So there are signs of weakening, but these are still solid numbers, right? Nowhere close to when we would expect a recession to kind of unfold or when we're creeping up upon a recession. So that's the mutual consensus so far. But I think that gray line on this chart is even more interesting than some of the employment data broadly.
And that's recent graduates?
Yeah, that's recent graduates. And I think for the first time in a long time, actually, we've seen the recent graduate unemployment rate tick higher, notably higher than the broader unemployment rate. And it's interesting to me too, and I'm pretty sure to you too, as a 09 grad or someone graduating directly into the recession. And I graduated directly into the pandemic, and I think we're both fortunate to have something lined up for us to eventually go and get some work done. But right now, what we're seeing is these new grads, they're having a bit of a harder time finding work, right? And it's hard to pinpoint that direct cause, whether it's AI and all the headlines you read about all of a sudden at coding jobs, Microsoft having 30% or Google having 30% of their coding done by AI, or maybe it's due to market uncertainty with respect to all the tariffs that have been going on. So it's hard to pinpoint that cause, but it's an interesting observation nonetheless.
Mm-hmm. Yeah, in some ways I feel very blessed and fortunate to have graduated when I did. Bottom of the recession, housing prices as cheap as they were, borrowing rates obviously super, super cheap. If I'm a recent grad right now, I'm very nervous, and there's a lot of, whether it's like you mentioned, tariff anxieties, just people coming off the back of a major bull market run and maybe fatiguing in the marketplace, and hiring plans kind of maturing, and then AI entering the chat, and just not having a lot of certainty in terms of how businesses are approaching it, and new job openings, and kind of trying consolidating roles and all these things. So anecdotally, we work with a lot of big tech, a lot of software developers and coders, and I've seen, if not employment softening, like wage softening, where they're trying to jump jobs, their offers are just materially lower or less competitive than they were just a couple of years ago when that whole kind of great resignation wave was playing out. So yeah, I think keep your eye on labor. I think this will be, we talked a little bit earlier about AI's prevalence and proliferation into market expansion or multiple expansion and profits, and how does that come at the cost of labor. I think in the next couple of years we're really going to start to see how our hiring plans, culling of workforces, automation of jobs, like how real is that and how fast will it play out? Because over a long-term time period, it's almost a foregone conclusion that automation and all of these things is going to become more prevalent in a lot of different industries. The question remains, how fast will agentic AI kind of make its way into different workforces and things like that. So yeah, I've actually been pleasantly surprised with how stiff and tough the labor market has been, but you are starting to see some signs of trouble there.
Yeah.
Let's talk inflation. Let's talk eggflation. I know that was all the rage here a couple months ago.
Yep.
What are we seeing in inflation data? Kind of walk us through the two charts we have in front of us.
Yeah, I'm sure everyone here remembers the pain of heading to the grocery store a few years ago and just paying an arm and a leg for what seems to be everyday essentials. But relative to a few years back, inflation has come down, right? The Fed hasn't had to fight, close to over 7%, over 5% inflation in a minute. If you look at what we have on the chart, the blue line basically represents the U.S. Consumer Price Index. This is and the year-over-year change, so change from last year, and that is measuring the change in price of a basket of everyday goods for consumers. And then you have so that's the core inflation index, and then you have the gray line. That is the just broad headline consumer price index, which also includes food and energy. The blue one strips food and energy out. And what we see here is, inflation has come down pretty notably, right? We're still a little bit far from that 2% target that the Fed has kind of declared as their goal, where core inflation, most recent print, was about 2.9% or so. Headline inflation was 2.7%. And the big question here is, are tariffs going to trickle through, right? And the Fed has kind of taken the stance of, hey, we'll go ahead and look past tariffs because that's kind of a one-time increase. And I personally feel like that's the right way to look at it. It's not like tariffs are going to increase 10% this month, another 10% the next month, and continue to compound that way. So I think they're very much so right for having this standstill posture of, all right, we know that tariffs are going to be impactful, but let's be a little bit more realistic with what that impact might actually be. And if that price impact can be split and absorbed by different parts of the supply chain, whether it's distributors, importers, or even consumers themselves. Because if we each absorb a third of that impact, the ultimate end impact to the final good, right, it's going to be not as much as if only consumers were to absorb that impact.
Mm-hmm. Yeah, I think we talked a little bit about the policy perspective and getting us out of COVID and printing a bunch of money and creating this raging inflation. And I remember, the consensus was this is transitory, and then oh shit, maybe it's not so transitory. It kind of turned out to be transitory, right? I don't think that outside of Fed raising rates, there hasn't been a crazy amount of policy intervention. We actually needed to do something to kind of put the lid on it, and arguably it's worked. And now I think we would have seen the Fed cutting rates if not for some of this tariff uncertainty. Fed seems to be very much so in a wait and see mode, which is let's let the data bear out. Like you said, who bears the end cost of tariffs and what do those tariffs actually ultimately look like? So not quite to the Fed mandate, but we're pretty damn close. So it seems like it's under control.
Yeah, we have seen a little bit of tariff impact in the most recent print, particularly a slight spike in apparel. Mm-hmm. But that spike isn't drastic to the point where the Fed has to be completely concerned about inflation resurfacing altogether.
Mm-hmm. Melissa and I, my wife, and we took a vacation to Madrid. We went shopping on the last day, and she was very pleased with how far money went in Madrid at some of her favorite stores like Zara and Mango. So maybe that's the solve. If apparel continues to run up because of tariffs, just shop internationally. I know there's probably VAT taxes and all kinds of other things that you need to be mindful of, and laws to not turn yourself into an importer. So don't take this as legal advice by any means. Tell me about the chart on the right. Obviously, eggs seem to have been tamed to a large degree, but gosh darn, coffee. I need to check my Amazon logs. Maybe I need to redo my habits.
I know you're one order of Grande Americano at Starbucks. I think you might have to rethink that and start making your own coffee at home. But this is a case where we're basically charting out the price of certain agricultural commodities, right? And yeah, eggs are the fun one. Everyone kind of remembers when eggs were, I was paying like $16 for a dozen organic eggs just to take a bite of some, chickens who laid eggs, so the chickens were like running pasture free and, having a good time, and eggs are delicious. But that's the thing about eggs too. I don't know if there's like a real substitute for the flavor of eggs. Have you come across something like that?
No, and I want to know where in the world were you paying $16 for a dozen eggs?
I mean, there were organic eggs, like to the highest grade at Costco, but
Wow. Okay.
still costing me an arm and a leg during that time a few months back. But yeah, I mean, obviously that's come down largely because avian flu or bird flu has come down as well. So the supply of eggs hasn't necessarily been as problematic as it once was. But let's talk about coffee, like you said, right? Coffee is one where we get a majority of our coffee imports from Brazil. And a lot of Brazilian importers have already started to hike coffee prices, largely in preparation for those potential tariffs to strike, quote it, August 1st or whatnot. So these importers are raising in preparation, and we are seeing that impact the price of coffee going all the way to $8.1 per pound when we talk about coffee ground roast. So yeah, you might have to be paying a little bit more the next time you make your trip out to Starbucks.
Might have to cut it down to just one double shot of espresso a day.
Yeah.
All right, let's switch gears again. Let's jump into actual Warren Street strategy performance this year. Let's talk through kind of big picture, then on to maybe some of the finer details of performance.
Yeah, so I'll start with our equity models. Global equity, which has kind of been bread and butter of what we've put forth relative to the MSCI ACWI, which is the MSCI All Country World Index. Year to date, we are underperforming the MSCI ACWI about 70 basis points. And a big reason for that is due to small caps exposures and US exposures. So we'll get into that in just a bit. In terms of our fixed income posture, it's the other way around, where relative to the broader benchmark being the Bloomberg US aggregate, our fixed income strategy is actually outperforming by 70 basis points. So you're getting a little bit of makeup there depending on which overall model our client's going to be in, whether it's moderate, whether it's conservative, whatnot. But I think the silver lining, or not even necessarily silver lining, but something that's really augmented our portfolio's return this year is the diversifier sleeve, really bolstered by things like gold, things like global natural resources and commodities are in there. International real estate is also in there. I think that's kind of the second leader in that sleeve. And specifically gold and international real estate, those are two asset classes that have done incredibly well and have helped really augment overall portfolio returns for our clients.
Very good. So 70 basis points under the All Country World Index on the global equity sleeve. So a little bit of underperformance relative to the globe, but let's call it 300 basis points of outperformance relative to U.S. large caps, and certainly a lot more if you're measuring mid caps and small caps included here domestically. So we'll take it. I mean, this is a time where our clients are thanking us for owning international stocks for the first time in a while, and diversifiers similarly. You talked about zigging when other assets are zagging. It's not always the most popular strategy. Because it's just different, right? It's gold, it's commodities, it's futures contracts, it's international real estate, it's infrastructure, net resources, stuff that's not necessarily always as in vogue as what's the S&P 500 doing. But this is a year where diversifiers as a strategy has really added a lot of value to our clients' lives.
Yeah, absolutely.
So what are some just broad perspectives of kind of how we're going to be spending our time in the back half of this year, just from a portfolio construct perspective?
Yeah, so second half of the year, our focus is largely going to be in three areas, which is number one, doing a broad rebalance for drift, right? Because gold has run up, international has run up. So just doing a rebalance to target, which effectively helps us get folks closer to the intended strategy that they were initially put in. So that's going to be on the table for later this year. We've also got some manager reviews just to reevaluate. Hey, certain managers that we hold, how are they sticking to their mandate? How have they performed? Where are fund flows headed? So we'll probably do some analyses there to better understand, all right, how would we grade this manager, right? Make sure we have that process in stone, and at the same time, ensure that the manager is committed to our philosophy and where there's overall buy-in into that holding. And lastly, we might be doing a few ticker swaps and revisiting things like U.S. concentration, especially with everything that we mentioned with where the S&P 500's at. So I think there's a room for us to kind of reevaluate, hey, how are we exposed to the S&P 500, and are we comfortable with how we're getting that type of exposure? So we're expecting to do some type of analysis there and see what we come up with.
Okay. All right, got it. So it sounds like portfolio construct is working. We're going to focus on kind of marginal tweaks around the fringes, ways to kind of unlock value, address concentration risk, and make sure that the managers that we are allocating to are earning their keep. Anything else broad market wise that you want to touch on here?
Not for me. I think we said a lot in this past episode, but yeah, I don't have a lot to add. I had a lot of fun doing this. Any final remarks from you?
Not for me. I'm excited to be back on. I didn't know I was actually sitting down for another word on the street, but I hope this is the first of many to come, and it's good to have you back.
Likewise, glad to be here.